Did we do CAPM? Bhavani, did we do CAPM?
Sir, I couldn't hear your voice. Your voice is breaking.
1 second. 1 second. I'll just switch off the camera for a moment. Did we do CAPM?
Yes, sir.
CAPM is through. So we are done with KD.
Not done. We just started like only halfway through.
Okay, CAPM. Fine. So can you guide me a little what was done in CAPM here? Okay, I'll just brief it out. Just tell me, was all this part done? So CAPM, the most important model of cost of equity. We learned that KE equal to risk-free rate plus expected market return minus risk-free times the beta. Okay. Example. Guys, if you wish to write it down for a revision, let's say risk-free rate into the country is 6%, expected market is 13, and the beta is let's say 2. So given this data, we can take KE, cost of equity, is 6% plus 13 minus 6 times 2. So 7 times 2 is 14, 14 and 6 is 20%. The cost of equity is 20%. Okay. Where here the risk RF represents risk-free rate. The expected market, that represents expected market return, where market represents any well diversified portfolio. Like Nifty in India, US S&P. Okay. Expected market return minus risk-free. This is like in our situation, this is 13 minus 6, that's a 7. That represents equity risk premium, ERP, or MRP, market risk premium. This could be a trap in the exam. They could give you ERP or MRP. So in that case, of course, you don't have to subtract it, right? It's already subtracted. There's some feedback. Hello?
Yes, sir.
Yeah, thank you. Thank you.
So ERM minus ERP is risk premium, right?
Sorry, come again, Tom.
Expected ERM minus RF is equal to risk premium.
Right? ERM is the wrong notation, sir. It's ERM or expected market. Na correct, na sir?
Expected market rate minus RF is risk premium, right?
Risk premium. Perfect. So this part is risk premium. But this is market is risk premium. For example, in our story, Tom, in our story, this was market risk premium. When you multiplied this to 2, for example, let's say this is beta of probably ONGC. Okay, so if when you got 7 is market risk premium. When you multiplied 7 to 2, you get 14. 14 is ONGC's risk premium.
With respect to that well diversified portfolio, as you said.
Absolutely. Okay.
What is beta here? What is beta?
Beta, we are coming to that. I was just in that flow. So I believe till here everything is good. Tom, we haven't learned this in the past. Tom?
Yeah.
Have we done? No, I'm asking. I really don't recollect because it has been 2 weeks and I don't have a written slide with me.
No, we have not studied.
So Tom, can you tell me
familiarity?
Sorry?
Because of familiarity, I was told. Because I was
told. Tom. Somebody has to tell me what did I teach in the class? What was the last thing we did?
CPM is not covered, sir.
CAPM is not covered. Thank you.
Yeah.
Did we cover dividend yield, earnings yield, Gordon?
That we have covered long back, you know.
Yeah, I remember that.
And you remember,
Long back, I remember. But
you
what
put a
all did
question
we
also
cover,
on
I
that.
don't remember.
You
Okay.
put a question on that also. That remember.
Great.
In the
That means
segment one.
that means we also are done with cost of debt, cost of equity,
Yes.
cost of preference.
Yes.
Did we discuss why KR and KE, cost of equity and cost of retained earnings, are different?
Yeah, if it is cost of equity and cost of earnings, yeah, it depends on situation, right?
Yeah,
If it is retained earnings is there, we'll be equating that both. Correct?
Lovely. ठीक है. So Ashok, Bhavani ji, I presume as Tom has pointed, we are not even done with CAPM. Okay, so I think we'll fresh start it. I was of the opinion that we have done some parts of CAPM. Okay, so let us fresh start. Give the title. CAPM, Capital Asset Pricing Model. CAPM, Capital Asset Pricing Model. CAPM, Capital Asset Pricing Model. Tom Kostov hasn't joined today. Was he there in the previous lecture?
Yeah, he said he has some urgent work. He has to go to the bank.
Got it. No problem. Okay. So, CAPM, Capital Asset Pricing Model. Unlike the other models we have discussed, right? Unlike the other models we have discussed, CAPM is an explicit model. Explicit model. Bracket means not implied. The others were implied. Ashok, dividend yield, earnings yield, Gordon, they were implied. Implied means what? We are implying from, just a minute. Bhavani, now my voice was clear. Ashok, voice is loud and clear. Tom?
Yes, sir. Clearly. It's clear.
Yeah. So when I say it's an implied model, my bad. I told it's an explicit model. That means other were implied model. Correct. Now, what is an implied model? Given the dividend, given the earnings, given the price, we were implying that what is the required return to equity. Correct? Guys, correct?
Can you repeat, sir, again? What is implied?
Implied means given the price, Ashok, given the price. So Ashok, just a minute. Ashok, wait, just a minute. See, Tom, just give me 1 minute. See, Bhavani, if we remember dividend yield model, KE used to be D1 upon P0 into 100. If we represent earnings yield model, KE is E1 upon P0 into 100. The P0 can be replaced with net proceeds. If we remember Gordon's, Bhavani, Tom, just check now. I've taught all three now. Gordon's model, it is KE equal to D1 upon P0 or net proceeds into 100 plus the growth. Tom, I've taught all three, right?
Yes.
Yeah. So ideally what happens now, Kaustubh, Ashok, Tom, Bhavani ji, see, ideally the current value P0 should be dependent on some kind of future fundamental. It could be dividend, it could be earnings, it could be dividend and the growth in dividend. So here now, there should be some kind of fundamental of the company. Correct? Based on that fundamental, we would discount that fundamental characteristic at a KE, and ideally we should find the price. Because so here what do? We have the price. We estimate the future fundamentals and imply what should be such KE which equates them. Are you clear?
Yeah, yeah. Sir.
Ideally, what should have happened? We should have predicted the fundamental, discounted by the KE, and found the value. Here we are taking value is equal to price, estimating the fundamental, and now implying the cost of equity, which equates that fundamentals ka PV with the present value. Makes sense now? That's why the three models I told Ashok, dividend yield, earnings yield, Gordon, they're weak models. Amongst them, the academic favorite at times is Gordon, academic favorite. The rest are stupid models. Correct. But if you compare CAPM is a different game altogether. CAPM is different, boss. CAPM cannot be compared amongst, at least with these three. Ashok could be to CAPM is the best. Are you trying to say that? Yes, but there are extended versions of CAPM as well. So we don't have it in BF, but you will have some gist of it in PTSA. Guys, are we clear?
Yeah, yes, sir.
Students, perfectly all right? Tom, Bhavani, perfectly all right. Okay. So, Kosto, these are called as implied models. These are implied models. But as you see, these say, given the price, given the fundamental, we are implying what should be the key. But now you compare the CAPM. Ashok, enjoy this. Ashok, enjoy this. We say KE is RF plus expected market return minus risk-free times beta. Now observe. Look at the right-hand side of all four equations. The company needs to give dividend. The company needs to be listed. The company needs to earn something. The company needs to be listed. The company needs to give dividend. The company needs to be listed and growing. That means in some way or the other, the company has to be profitable or giving dividends or growing or maybe a combination of all of them. And then only I can find the key. Correct? So are you trying to say, are the models trying to tell me that, sir, if there is an unlisted company, Ashok, denominator gone. I don't have the denominator. If there is a loss-making company, so numerator is gone. You cannot find the cost of equity. Aisa thodi hota hai. Ashok, that's not the case, na? Bhavani, if Bhavani ji, an investor, or Ashok, an investor, he wants return because he's taking risk. So if you see the depth of CAPM, CAPM says, I require this much because I'm taking that much risk. Hello, am I making sense?
Yes,
Right?
sir.
Lovely. Thank you, Tom. Thank you, Bhavani. Thank you, Ashok. So ideally, na Ashok, the logic behind CAPM is that, sir, this much the investor should get without risk. This is what he wants to bear average risk. When I say use the word average risk, market risk. Market risk. And this is the scaling factor of market risk. This scales it up, this scales it down. Depends upon whether the company or the industry you're talking about is riskier than the average. So for example, a pharma company is less riskier than the average. Ashok, even today, I'm sure everybody knows what is happening since the last time we have met until now, things have changed. Correct? So even today, if you happen to see pharma stocks, IT stocks, they are not falling much. Correct? But if you see the whole Nifty, it's cracking. It's falling like a pack of cards. So Ashok should be, what do you want to say? I'm going to say, not all businesses have the same risk as market is. Some business have lesser risk than market. Some business has more risk than market. Hello. Guys.
Yes.
Correct. So the last factor scales the market risk up or down. And for that, you need to remember market risk, we take the beta 1. So we compare it to 1. So we assume, actually it's a mathematical calculation, but we assume, we consider market ka beta as 1. Hence, betas of security greater than 1 are aggressive, riskier than market, usually banks, real estate companies, metal companies. Beta of companies lesser than 1 are defensive. When I say defensive means pharma, FMCG, utility-based companies whose consumption is not that much impacted due to market-wide factors. Am I making some sense to you? So that into multiplication of the beta factor kind of scales it up or down. Hello.
Yeah. So
Yeah.
here in this case, higher the beta, then higher the cost of.
One by one. Tom, 1 second, dear. Ashok, come again.
So in this case, higher the beta, the higher the CAPM will be.
CAPM is the model. So
Okay.
it's not higher the CAPM will be, higher the cost of equity will be.
Cost of equity, yes.
CAPM to model है, title है.
Yeah.
Like Gordon's is a title. Yeah, these are the titles. CAPM is a model name. You should say higher the beta, higher the cost of equity.
Cost of equity, yes.
Okay. Yeah, Tom, you were saying something.
Sir, this CAPM model, that particular that we are finding the equity cost of equity of a share like. So it should be listed on the diversified portfolio, or it should not be listed.
Very good, very good. So Tom, let me rephrase your question. I'll rephrase your question. There is a Ashok. Tom, we haven't done how to find beta. We have not done till there, right? How to find beta, we have not done, right? Covariance by variance, correlation sigma.
Regression coefficient, right?
No. Have I taught you how to find beta?
No.
No.
We just told like that only.
Okay, Tom, let us first pen this down. Then within 5 minutes, once we are done, we'll start about how to find beta. Just give me 5 minutes. Correct, Tom? If anybody wishes to take this example again, and this is the story which connected CAPM. So Ashok, we understood that others were implied models. CAPM is an explicit model. One query of Tom is still unanswered. Tom is like, sir, but how to find beta? And is it only for a listed company? So I'll answer that. Just give me 2 minutes for this. Let's absorb this much till here. Tom, perfectly all right? Correct? Perfect. Thank you, Tom. Thank you for being so patient. Anybody is copying? Quickly do it. Tell me a yes or no once you are done.
Give me 2 minutes.
You're done? You're copying now?
No,
so this is the formula of cost of equity using CAPM. Correct? So as you may see, there is a risk-free. There is a market return, what we expect. This you can get from the past also, or you can predict for the future. This is the beta of the company ONGC. Let's say ONGC. So I have got the cost.
Defensive stock, sorry, it's okay.
Continue, please. No problem.
Sir, defensive stock means it won't be going up to the market level, right? Or it is going down the market level.
Defensive usually means less sensitive. So consumption stock,
it won't go up the market. It will go going less than.
It rises slow, it falls slow. It reacts less to the panic.
Yeah.
Correct.
What is the opposite of that defensive stock?
Aggressive. Volatile stocks. Correct. So usually the businesses which are very sensitive to, like for example, if you Tom, knowing that you are smart on this, okay? Knowing that you are smart, not believing, knowing. Tom, businesses like banks, real estate. These are kind of businesses, metals. These are the businesses, auto, four-wheeler, in that also premium. These are the businesses, they are very much macro factor sensitive. Because see, it's basic economics. I'm not exaggerating it. It's a basic economics. Ashok, you're too smart. Tom, you're too smart for this. It's basic economics. If something changes macro level pay in a bad way, correct? In a bad way. So indeed, these businesses will lose consumption to the best. Now. Banking business consumption will be lost, services will be less used, auto sector sales will be falling. Obviously, vice versa. If something good happens, economy is growing crazy rates, GDP is growing. Indeed, in that situation, these businesses' revenue will grow at a faster rate. So, Tom, one value addition I'll do to you, sir. The beta boils down to two factors. The beta boils down to two factors. One is the business risk, other is the financial risk. Business risk, financial risk. Ashok question, businesses, sir, how economically your business is sensitive? Connected to the price elasticity. You're just connected to price elasticity, GDP elasticity. Like economic cycles, how your business gets influenced. Correct? Second, do you have lots of gearing, lots of leverage on your books? The compound effect of business risk and financial risk brings your beta up or down. Tom, am I making sense, sir? Tom, in a way, this was the answer to your previous question also. The question was, is the company supposed to be listed? Tom, ideally, it becomes easier to find beta for a listed company because I can do the math very conveniently, correct? No? But if it is not listed, still there are ways to find beta. Did you get the answer?
Maybe because of that industry type of
Exactly. Industry or sales or profit or earning sensitivity, some way or the other, we'll try to relate some fundamental of the company to the market factor. If it is listed, great. If it is not, we'll use some economical factor and relate it to the market factor. Are we clear, Tom? Ashok, any problem?
No, all good, sir.
All good. Thank you. Okay, please take this down, Ashok. Once done, I'll scroll the slide down if you want anything from the other side.
Yeah, I noted this. In the next slide, I want to copy next slide also.
Yeah, sure. So beta of market is taken as 1. Ashok, beta of market is taken as 1. Beta of aggressive securities are greater than 1. All good? Hello, all good?
Yes, sir. Defensive less than.
Sorry.
Defensive shares like non-aggressive.
Less than 1. Correct. Yeah.
So here yardstick is 1, above 1, below 1. Correct.
Usually we don't comment on negative beta because fundamentally we describe that beta can't be negative fundamentally. However, statistically at times you might find companies which have negative beta. Negative beta would mean that these companies are working exactly opposite to the market. Tom, you understood now? Negative beta. See, positive beta means what? If the market is doing good, positive, negative. I'm not saying one. I'm saying positive, negative. So usually Tom, could you add one more thing, Ashok? This is one point. Sir. This is 1 point. This is 1 point. One more. Beta of risk-free asset is 0. Beta of risk-free asset is 0.
Sir, in the dividend yield method, D1 by P0.
D1 by P0 or net proceeds. See, yield is always related to market price. Okay, yield is always related to market price.
Or NP means
net proceeds. So at times you do the calculation for a company which is planning to go for a new share issue. So sometimes what happens? The current market price is 1,000 rupees. But when you issue, you might have to issue it at 2-3% discount to the par. Or even at times you have to pay some flotation cost of another 2-3%. You understood my tone? So to make the issue attractive, sometimes you don't issue at market price. You issue at slightly discount, 1-2% discount to the current market price. And also there will be some kind of an intermediary who will ensure that the issue floats properly, who will charge you 2-3% for his services. Hello.
Yeah.
All good?
Yes, sir. Do we expect any mathematical questions from this formula, sir?
Yeah, of course.
Here only mathematics comes. Correct, sir? Here only the mathematical part question.
Yes, indeed.
Gordon says cost of equity D1 by
Equal to
P0
D1 upon
divided with
P0 or
P0.
net proceed into 100. So that becomes dividend yield, correct? Then you add the
Yeah.
growth. Growth can be understood like capital gain yield or growth in the earnings or profit. Growth in dividends or earnings. Okay. Is this done till here?
Yes, sir.
Okay. Shall we continue?
Yeah.
Okay. So fine, Tom, thank you. Okay, so we are done with the CAPM thing. Okay, how to find beta? Title, how to find beta. Title is how to find beta. How to find beta. Okay. Okay, so beta, guys, on screen, let's say beta of ONGC. Okay, so it should be covariance of ONGC and Nifty upon variance of Nifty. Don't copy. In simple language, I'm trying to say beta of a security I should be covariance of that security I with market portfolio, the whole upon variance of market portfolio. This is a generic formula. As you remember, covariance of any item with market, I mean any two item, is basically product of sigma of that item security, sigma of market into the correlation coefficient of security and market. So I can replace this numerator with the product of these three. So beta of the security will be sigma of the security into sigma of the market into the correlation of the security and the market, the whole upon variance of the market. What to get from here is it is correlation of the security and market into sigma of security upon sigma of market. This becomes the formula for beta. Come on, all good? Guys, all good?
Yes, sir.
Okay, please take this down.
Can you okay, beta. What was the last one, sir? Sigma I market I multiplied with RI.
Correlation of the security in the market. Look at the left hand side, Nadir. Here, look at this side.
R.
So covariance, Ashok, see, I'm not your stats professor anyways, correct? But I like that subject in my CA curriculum, CFA curriculum. We used to have that quite significantly. So, Ashok, I asked my colleague, and rather I should have said my teacher. Then he became my colleague when I joined the teaching industry. So he gave me a very beautiful way to understand covariance. Okay, I'll just pass it on to you. Ashok, when you talk about covariance between two items. Indeed, he said, look, if it is covariance between I and J, two items, I and J. Okay, yeah, let's say Reliance and TCS. Okay, so it's a product of three items: movement within Reliance, movement within TCS, movement amongst Reliance and TCS. In simple language, sigma I, movement within Reliance, sigma TCS, movement within TCS, correlation of Reliance and TCS. It's a product of three items. I hope I'm making some sense to you. Lovely.
Yeah.
Thank you, Bhavani. Thank you. So, Ashok, by this, now you can remember this formula throughout. Covariance of any two items is the product of sigma I, sigma market, correlation of security and market. Okay. And this becomes the derived formula. Are we through?
Yes, sir. Just
Okay.
yeah, let me finish.
Yeah, go ahead. Just 1 second, Ashok. Ashok, done?
Yes, sir. Noted.
Sorry. Any point, any doubt, anybody? I'll take this away. Guys, I'll take this away.
Yes, sir.
All the 3 slides I'm wiping off. Huh? Any doubt, anybody? Okay, I'll take that as a no. Another example. Please write down. Write down.
Sir, we usually take beta as positive only. We won't take negative value.
Fundamentally, see, Tom, this is a very old argument in a good sense. Huh? It's a very old argument that, sir, can the beta be negative? Long time back, Ashok, we used to also spend time in classrooms to discuss can the betas be negative and get me the negative beta companies, right? So we used to give time to students to think about the beta. Nowadays, I've stopped that. You may wonder any reasons, sir, in particular. Tom, very rarest of the rare situation, you will find companies or businesses whose fundamentals are negatively correlated with the market. Tom, just look at that covariance formula. Tom, look at the covariance formula. Look at the covariance formula. Do you see the covariance formula is sigma correlation? Sigma correlation, correct? Sigma has to be the positive square root of variance. Correct? That means the only item which can make covariance, thereby beta negative, is a negative correlation. Are you clear with that, Tom? Lovely. Tom, now let's talk fundamentally. So a company who has a negative beta, what are you talking about that company? Not you. What are you, as in not Tom, you as a person? What are you talking about a negative beta company? That means that company is fundamentally negatively correlated with Nifty, with the market, with the economy, with GDP. Okay. Now, Tom, you are aware of Indian market, Tom? I mean, just asking you, are you aware of Indian markets? Because I don't know the geography of the batch. Are you
Yeah,
into
yeah.
Indian markets? Lovely. Now, then you must be aware of the company Idea.
Yeah, yeah.
Yes.
What of
Correct.
idea?
Okay.
What of?
Let's take Idea. Tom, have a look at the stock prices of Idea. Let's say for the last 10, 15, 20 years. Okay. Can you see it on screen? Hello? So everybody understands post this Reliance entered into this market and the value is totally destroyed in Idea, right? So vis-a-vis, if I just compare a Nifty representing market for the same time period, Nifty for the same time period has been going up consistently. This was a glitch during the COVID time, else it was a very good, smooth, beautiful upward market. My point is, Tom, if you do this mathematically, the beta and all, if you do mathematically, can I say you will get the beta of Idea negative? Because as you see, market was going up and Idea was going down. Tom, some feedback? Correct? But does that mean that telecom utility companies are economically negative to market? You understood my question?
No, it won't be negatively correlated. But only thing is that investing in that share is not good for personally, which is not good. That is right.
No. We are not getting into that part. We are just getting that means there is something fundamentally wrong with the company. Tom, I was expecting your argument will be, sir, Idea, there is nothing wrong with the telecom as a product. Problem is with the company, that there is another big giant who has entered the market and who is taking away your business. Tom, I'm sure I'm making sense to you. Correct?
Yeah,
Now,
market share is going down.
So there are very, very few businesses who are fundamentally not something bad with the company, fundamentally opposite to the market. Very few companies. Are you clear? Correct, Tom? Lovely. However, if you may think, Kaustubh, long time back, I GPT'd also. I mean, this is pre-GPT era, to be honest. So I Googled at that time that do we have businesses which are fundamentally negative? Ashok, Bhavani, fundamentally negative. So it gave us a business of a law firm who is expertise into NCLT. A law firm having expertise into NCLT. Can anybody think about this? Tom, so in gruesome times, cruel times, such business will have lots of money to make. And if the economy is booming, things are going fine, things are doing great, in those situations, such businesses will do poor. They're not so good. So economically, if something is making money on the plight of others, Bhavani, if some businesses are making money at the plight of others, those businesses will tend to have negative beta. We can't say no, but they're very rare. Bhavan, thank you, Bhavani. Ashok, Tom, are we convinced?
Yeah, I mean, that means fundamentally it is a good company. Fundamentals are correct. Only thing is that as an investor, investing in that money won't give you greater beta, right? Greater.
No. I disagree totally. Sorry. I disagree totally. Beta alone will not help you to make that clarification. Second, beta does not tell you the fundamentals. Beta just tells you, dear, that whether it's high, low, positive, negative, that means the business risk and financial risk collectively are high, low, or
That
are
is
they?
historically, it is historical data only.
Tom, let me finish. Always let the teacher finish. Correct?
Okay.
Yeah. So it will tell you whether it's high, low, or it's positive, negative. It won't tell you whether fundamentally it's a good company or a bad company. For that, you need to do some other calculations. So I disagree with the line कि beta will tell you whether investor, is good. I mean, should invest or not. But again, repeating, beta tells you whether the stock, the business is positively related or negatively related. Second, whether the it's aggressive or it's defensive. It does not tell you anything about being the business is good or bad. Yeah, Tom, please continue. You may continue, sir. Tom?
That means historically, it is historical data only. No, it is that we are
Beta can
analyzing
be,
the trend only. Correct.
beta can be historical also. Beta can be future also. Means if if there is a reason to believe that history is not a good proxy for the future, in that situation, you can take forecasted return, thereby find the forecasted beta. Tom, clear?
Forecasted beta is related to historical data, right?
Forecasted return, what?
Forecasted beta is a function of historical data, no?
One of the factors. But
Yeah, because
the
it is related to historical data.
the weighing of that factor depends. For example, if you see, Tom, Reliance's data, see, Tom, we both are having a discussion that is history a good indicator for the past. So it depends. I mean, I would love to say no, but still I would say it depends. See, Tom, if you see Reliance's performance from 2005 till 2016, 17, it was such a flattish stock. But fundamentally, something different happened, and look what happened here.
That is because of political intermixing.
No, that is because of Geo.
So,
Geo Finance, Geo Telecom. Tom, if your answer is because of the political, then this should have started in 14. Tom, saying that history is a good indicator, it's more like trying to drive a car by looking in the rear view mirror. Maybe there are bumps ahead, but the past road was very clean. History could be an indicator, but you cannot rely on that totally. Okay, you can rely on that if there is no fundamental change. If things have changed totally upside down, history is no longer a good indicator.
No, that because in this intervening period, that regulatory there is a regulatory which is in favor of Reliance. That may happen. No?
Geo was the new
Geo,
blood.
Geo. Yes, Geo.
It's not regulator. It's new business what they entered into here. Okay. Tom, are we convinced? Yeah, thank you. Ashok, Bhavani, are we okay with this? Okay, we can take 5 minutes. Ashok will take 5 minutes rest. I'll take one big example. That big example will cover the whole story till now. Okay, we'll take the market value weight, we'll take the book value weight, we'll go for the KD calculation, KP calculation, and KE calculation, and also the KR calculation. Yeah, KR, I'll give it to you. I'll check what I could do, and we'll find the book value, market value. We'll do a whole calculation. So this particular question will be revision till now. Okay, take 5 minutes rest on this, then we'll continue.
Okay, sir.
Let's start. Kaustubh, Ashok, start. Shri,
Yes, sir.
thank you.
Okay.
Okay, example. Now, let's say there is a company, let's say, for example, a PTC industry. PTC Industries. It has got some sources. Equity share capital of face value 100. Retained earnings. 10% debenture. Again, bracket face value 1000. And a 12% PSC. Face value 100. Okay. As per books, ESC is worth 100 lakhs. Retained earnings are worth 400 lakhs. Debentures are worth 300 lakhs and PSC is worth 200 lakh. Together, this is 1000 lakh. Market value. Now, Kaustubh, Ashok, giving this data, assume, guys, given data, let's say the market value of equity is 1200 lakhs. Retained earnings does not have market value. Debt is trading at 310 lakh and PSC is, let's say, trading at 220 lakh. So this is the total enterprise value of the company. Now, further, given number 1, risk-free is 6, expected market is 13. Beta, okay, I'll just take away the beta. Correlation of PTC with Nifty is a plus 0.9. Sigma of Nifty is 18. Sigma of PTC is 12. Okay. Second, pre-tax KD is 9.5 and KP, cost of preference, is explicitly given as, let's assume, Tom, we had done that YTM approach, na? IRR approach to find the KD and the KP. Tom?
Yeah.
Yeah, we had done
I
it.
think-
Right? So I'll just give the data directly. Pre-tax KD is 9.5% and KP is 12.2%. Let's make it 11 point something. Actually, it would make more sense. 11.7%. Corporate tax rate also given. Let's assume 25%. Okay. I think this is sufficient for you. You need to find WACC. A, using book value weight. B, using market value weight. You've got 10 minutes. Please start.
Sir, can you share that screen? And left side, what is 10% debenture? Is it debenture?
Yes,
Debt.
it is debenture. Debenture means borrowed funds.
10% debenture.
I'll read out the whole thing to you.
Yeah. Until that, and RE, that return on equity, market value is 0, is it?
RE is retained earnings. Retained earnings never trade in the market, na?
Okay, retained earnings.
Retained earnings is accounting concept, right?
Yes.
The 1200 lakh, which is the market value of equity, it
Equity share.
actually incorporates part of RE also. Are we clear?
Yeah.
Yeah, okay.
300L, 310L. What is PSY? 12%?
Preference share capital. 12% preference share capital.
Share capital. So in the second one, TC is 25%. You know?
Yeah, tax rate is 25%. Yes. It will be helpful to calculate, convert the pre-tax into post-tax. Ashok, have you started?
Yes, sir. Trying. So first we need to find beta, right? That's what I'm doing.
Yes, lovely, lovely.
So
So
cost of equity is around 7.15.
just let me also try. Very good. Tom, very nice. Beta will be correlation into sigma sigma of the security with market, security and market. The correlation is 0.9. Sigma of the security is 80. PTC is yes upon 18.
18.
So this should be 0.6.
1 point.
0.6.
0.6.
Now we will apply CAPM
CAPM.
from
Correct. Using CAPM, finding KE, we get 6% plus 13% minus 6% into the beta of 0.6. 7 into 0.6, 4.2. I think it's a 10.2.
Yeah, 10.2.
Okay.
Yeah.
Okay. Now going for WACC, sources, WACC using book value
And
weight.
cost of equity is cost of debt we have to find out, no?
Yes. So
Cost of debt is
post-tax KD will be
1
equal to
minus T into 1 minus T into
9.5.
9.5.
Lovely. Can I have the number?
It's 7.125.
125. Thank you. So we'll have sources, book value. So we'll have ESC, RE, debenture, and PSC. Their book values are given 100, 400, 300, and 200. This is the 1000. The weightages can be taken as 0.1, 0.4, 0.3, 0.2. K, equity ESC is 10.2. We assume they're equal. Debt is 7.125 and this is 11.7. The product should be WACC, also represented by the letter KO. Please solve till here. Tom, can I have the numbers?
Yes, sir, I'm doing it, sir.
Yeah, sure.
At point 0.102 into 10.2, no?
0.172. From where did you get that number?
No, 0.102.
No
That
problem.
one.
No problem.
Yeah.
Go with the way you do it. I got a 9.5775. Somebody please verify.
Yeah, I also got 9.5775.
Lovely. This was WACC using book value weight.
Book value.
We need to now find WACC using market value weight.
This is in percentage, right? Yeah.
Yes, yes. 9.5775 is a percentage. Has everybody got till here?
Yes.
Lovely. Proceed, may I?
Yes, sir.
Okay.
We can do market value.
Now the same math is to be done by using market value weight. Okay, same math is to be done by using market value weight. Okay. I'll try with this much piece of space. Ashok, just hold it for a moment. Huh? I need to teach you something here. The way you were reacting, I believe you have not attended this. So, sources. Now, equity. Now, Ashok, because KR, cost of retained earnings, is not explicitly given, we have assumed KR equal to KE, which is again the same as 10.2. If the question would have mentioned KR and KE are separate, we would have done some changes here. Okay. Now, sources mein ESC, we don't write RE now because the KE and KR are same. Hear me out, be patient. Debt and PSC. We write the market values. The market values, I remember, they were 1200, 310, 220. So 1200, 310, and 220. This, instead of ESC, I can write equity, market value. So this total becomes 12, 15, 15 to 17, 17, 30. Then we need to find the weights the way we did previously, and the K we had already found, and we'll find the back. Ashok, nothing to teach, things are simple. But suppose, only for you I'm doing this again. Everybody, Tom, Ashok, Bhavaniji, suppose if KR and KE were not equal, if KR was not equal to KE, suppose the question maker had given KR as 10 and KE is, as you know, 10.2. In that situation, the calculation under market value weights will be this: equity, retained earnings, debt, PSC, market value. Ashok, focus higher. The debt and the PSC has a market value of 310 and 220. So 310 and 220. But the ESC, which has a market value of 1200, needs to be split in ESC and retained earnings in the ratio of their book value. I repeat, the market value needs to be split in this proportion. Because Ashok, as you know, the retained earnings don't trade, but their K is different. Na? This is 10.2, this is 10.10. Come on. So their amounts has to be split in the ratio 1:4. So 1/5 and 4/5. So 1200, 1/5 is 240. And somebody help me with this. 960. Guys, are we there? Ashok, did you understand
Yes,
what did I do? Now you compare and contrast this with the previous question. Here we directly took 10.2. We did not do the split. Because
Yes.
KR and KE are same, the split does not make sense. But when they are different, the market value of the equity needs to be split amongst ESC and RE in the proportion of their book value. I repeat.
Provided cost of equity, cost of retained earning is given.
Given, or we find it some way or the other. But if KR, you please write, everybody write down a sentence somewhere very important. Remember, whenever KR is not equal to KE. Tom, we don't care about the reason right now, okay? Tom, whenever KR is not equal to KE, and due to any reason there, correct? Hello?
Yes, sir.
Whenever KR is not equal to KE. In that situation, we will take the market value of equity. We'll take the market value of equity and split it, या bifurcate it between ESC and RE, between ESC equity share capital and RE retained earnings, between ESC and RE on the basis of their book value proportions. On the basis of their book value proportion. Ashok, can you read it out to me?
Yes, sir. Whenever KR, cost of retained earnings, is not equal to KE, in that situation, we will take the market value of equity and split it between equity share capital and retained earnings on the basis of their book value proportion.
Correct, na?
Yeah.
Correct. So as you may see, I did it over here, hai na? And I don't remember what was the KD. So KD, Tom, KD we had found, na? 7.125 and KP was 11.7. So 7.125 and this was 11.7. 11.7. Based on that, we'll find the WACC. I'll solve both the example. I'm solving both the example. So I hope you are trying it. Ashok, Bhavani ji, just remind me, we are done with this example. So next time I'll proceed on this ahead. 1200 plus 310 plus 220. So got 1730, correct? Yes. Then 1200 divide RCL1. So get 0.693. 310. 0.179. 0.127. So debt is 7.125 and this is 11.7. So 0.693 into 10.2, that's a 7.068. 0.179 into 7.125, 1.275 into 11.7, 1.4859. 7.068, 1.275, 1.4859. 9.8289. Similarly, Tom, I forgot to give them the weights. I'll have to give them weights before finding WACC. So I have to give them weight and WACC. So the total needs to be same, 1730. So the weight will be almost same here, 0.179. And this should be 0.127. $240 on this is a 0.139 roughly. And this is the 0.555. 10.2 into 0.139, 1.4178. 10 into 0.555, 5.55. 7.1725 into 0.179. Cost of this was 9. Yeah, 9. So this is 1.2838 and 11.7 into 0.127. That's 1.4859. Okay. Plus 1.2838 plus 5.55 plus 1.4178. 9.7375. Is this clear?
Yes.
Okay.
Can you brief it from the beginning, like if it is retained earnings, escape, and then just a brief.
But what part?
That cost of capital, that cost of equity, that retained earnings, market value, and these things.
You just split it. You split the total market value of equity on the basis of the book value. The book value
book value,
given.
no problem. Book value, we have all the retained earnings are there.
Tom, let me finish my line, sir.
Yeah.
You split the 1200 on the basis of 100 and 400. Let me complete my line. So 1200 is split on the basis of 100 and 4. 1:4 basically. The 100 and 400. And once you split it, you get the amount 249.60. You take the amount over here. The rest two amounts were same. This time only K is different. Correct? Hello, are we clear?
Yes, sir, clear.
Okay. ठीक है. Chalo, we'll call it a day then. Next lecture, we'll try to wind up the chapter. There'll be some more interesting aspects. It'll be fun. Okay. We are almost. Yeah.
Okay, sir. Just proceed.
Okay. Yeah. Thank you. Chalo, see you next time. Bye-bye. Thank you.
Thank you.
Thank you, sir.
Thank you. Bye-bye.